All right. So now it turns out that now since we're now covering GDP, I found some very interesting videos, which I think you'll like, which will help introduce the topic to us and from different perspectives. So what we're going to do here is I'm going to go over to Moodle, and as just like I have done before, I'll pop it into the chat room, and then you can watch it on your screen, because if I show it here, the sound may not work at all or very badly. And so it's easier if you watch it on your screen. So let's go look at Moodle for a second and find these wonderful new videos. And I think you'll agree that they're all very well done. And they'll give us a very exciting introduction to the topic of GDP.
Yeah, I feel you.
All right, so hold on one second. Let me go get these guys open.
Nobody, no time to come. Like, I'll join the class and he'll already be talking about the lesson. And it's only been 3 minutes since class started.
Yo, you're unmuted.
Kristen, you're not muted.
Uh-oh. Oh, yeah. There it is. Okay, they're all muted. Okay. I can only scroll through these so fast, but all right. Here it is. So anyway, what I would like to be able to do, I'm trying very hard to keep all the notes posted in time, but also the links, because the problem here is that I think I mentioned this once before, that I have to be careful about showing the videos in the recording, because we could potentially violate copyright laws. So what I've been doing is pausing the recording while they're being shown. So what that means is, if you're not here, if you're late, or if you can't come to class and you watch our recording, you're not going to see the videos unless you have the links. So they're all right over here. And we're going to go in the same order. You're seeing them right here. And by the time we're done, you'll have a pretty good sense of what GDP is and how it's measured and why it's so important, which is, as it turns out, GDP measures the output of all the goods and services that we produce during a given year. And it's a very good way of measuring what our standards of living are looking like. In fact, in a lot of ways, it's really no different than looking at the annual income of an individual. Okay, because ultimately GDP represents what we produce, and that also ultimately determines what we can consume. And so it turns out to be a hugely important idea. And it also gives us an opportunity to introduce a lot of other extremely important macro concepts that we'll be using throughout the course. All right, so that being the case, why don't we check out this first one? I'll just pop it into the chat box. First, here it goes. No, let's stop that right now. Let's put this in the chat box. And let's make sure everyone gets it, because occasionally problems happen, even with the chat box. So there it is. So I'm going to stop the screen sharing. And why don't we check this? Whoops, that's not what I wanted. We'll stop. Oh, here it is. Pause the sharing. And then why don't we start and watch the video?
Recording in progress.
Still don't hear him?
Recording in
All right, are we all pretty much done?
Yeah.
I thought
Yeah.
that was kind of a bizarre example at the end with the polar bears. I'm not quite sure what that was all about, but I think what they were trying to say is that they're not every single product or every item is included in GDP because of several reasons, among them being there may not be a market price. Well, I'm not sure what that polar bear thing was all about, but they are saying that GDP does a good job of capturing what we're producing, but it does leave some certain things out. And as we go along, we'll see some of the items that are being left out, and you'll see that there isn't really a whole lot we can do about it. A perfect example of this is that if you perform a service for somebody else, but you do not get paid for it, it does not include itself or get included in GDP because of the simple reason that no money changed hands. So in that sense, there are problems with GDP. It's understood that GDP tends to understate the true value of what's being produced in the economy. But realistically, the best we can hope for is to keep that down to a minimum with the understanding that there are a lot of valuable items that do not end up getting included. And it's the same problem with every other country in the world. Everybody does this slightly differently, but we all run into the same issues with what to include and what not to include. All right, so let's try the next one. This is called GDP and the circular flow, which we did touch on earlier in the course. So let's see what this one is all about. Hold on a second. Okay. Let me pop that into the chat room. And let's check it out. right, are we pretty much done?
Yeah.
All right,
Yeah.
good. All right, good. So now, yes, we're ready for number 3. This is coming from CNBC, by the way, which is a website which if you've never checked it out, you really should, because this contains all kinds of excellent information about what's going on in the markets. It's got the news, it's got all the stocks, and you can see up here, for example, the Dow Jones is up 89 points today. The S&P is down 1395. Ooh, the NASDAQ is down 211. So something, yeah, I was going to say something specific is going on here. Apple and Tesla, for some reason, are having a rough couple of days, and they are both on the S&P 500 and in the NASDAQ, whereas they're not listed over here. So that's why the Dow is having a nice day, whereas these two are getting hammered because for whatever reason, investors have temporarily started to lose confidence in these companies. But you know what? By this time tomorrow, who knows? Everybody will be buying these stocks again. But there's all kinds of great news. If you look at all these links, there's all kinds of great stuff here to look at, not just for your own schoolwork, but also, you know, at some point in the future, you will actually have money to invest yourself. And the more you learn about it, the better off you'll be. All right. Crypto. Yeah, crypto. Well, you know, what happens with crypto is it's a very volatile asset. And even the least change in consumer confidence can cause it to go way up or way down. So here, look at that. You're right. Bitcoin is down by over $5,000 today. Oh my God. I don't know any of these other ones. In fact, I don't really even know what Bitcoin is myself. I know it's a cryptocurrency. That's all I know. All right. Beyond that, I have no idea. Let's see how gold is doing. Woohoo. Now, usually, here's the thing about gold and silver. They have a tendency to benefit from turmoil in the market. So in a way, this may not be the best thing in the world for us. We're seeing gold, silver, copper, and palladium are up. Platinum is somewhat down. Oil, crude oil, it's hovering around the same levels it's been for quite a while now. These are yields on different bonds that are available in the marketplace from the United States. This is Germany, Japan, Great Britain, and France. We have Asian markets. Nikkei is the Japanese stock market. Shanghai, obviously, is China. This one, I think, is Hong Kong. This one down at the end, I believe, is
Professor?
Korea. Yes.
Your screen is frozen. We just see your emails.
Oh, that's right.
It's not
Oh,
emails. We see your like legacy thing. I don't know what that is.
Oh, you're right. All right, let's go back for a minute because
Now
all
I
right.
see it.
Okay, sorry about that. I forgot that the thing was off. Let's go back to the beginning. CNBC, as I was saying, is an excellent website for getting a lot of information about what's going on in the financial markets. And so I was noting that for the U.S., you can see that the Dow is going up, but the Standard & Poor's and NASDAQ are falling. And that's apparently there's both Tesla and Apple are having a rough day for some reason. If we want to know more about this, we can jump to this article and they'll try to explain to you why. Yeah, I guess for whatever reason, the markets are nervous. There must be a meeting of the Fed coming up pretty soon. And the investors, of course, are always worried that interest rates will start going up again. And so they're saying here that if that happens, it would be harmful to companies like Apple and Tesla because they're rapidly growing companies that, you know, let's face it, they're able to benefit from having very low costs of borrowing. If that changes, that could harm the profits of Apple and Tesla. So, I mean, that's the kind of thing, nothing's actually changed, but investors are nervous about it. And that's all it takes for the prices to start dropping. And when those prices start dropping, then the entire indexes that we're looking at here can drop as well, because these are two of the bigger shares on the NASDAQ and in the S&P 500, which, by the way, this is an index of the 500 largest stocks in the economy. The NASDAQ is an actual exchange where high-tech stocks tend to be traded. The Dow Jones Industrial Average is the 30 so-called blue chip stocks. The biggest and best known companies are traded here. The Russell 2000 is 2,000, I think it's the 2,000 largest shares. The VIX is a volatility index, which tends to benefit from market turmoil. So when the VIX goes up, that means usually something's going wrong in the marketplace. And then you can jump over here to see some of these others, like crypto. Somebody mentioned it. Bitcoin is falling off quite rapidly. You know, for any normal asset, losing 10% in a single day would be catastrophic. For Bitcoin, it's just par for the course. It's so volatile. In fact, if you were able to look at a history of it, let's say how far back should we go? A year even. October of 18, it was at about 6,000. Now it's up around 53,000. That's a very volatile asset. I think partially that's because nobody really understands what it is. And so who knows what to think. And you get these ups and downs. Like here, it got way up there for a while and then it dropped off for a while. So this is nothing new for these cryptocurrencies. And there's others too. If you've ever heard of any of these, I don't know. I don't really know anything about this area, but then the European Union, these are the European stocks. They're all having a rough day. DAX is Germany. This is Britain. This is France. This is another version of the FTSE market. And I'm not sure who this one is. But see now, European markets close lower on US bond yields. In other words, the fact that people are suddenly thinking that interest rates in the US are starting to rise is enough to not only send the prices of Apple and Tesla down, it's also causing investors to be nervous in Europe. And that's because if the US economy slows down, they'll be able to sell less products to us, and that will slow down their economies. And so just the mere fact that people are thinking that there's a possibility of US rates going up is enough to send all these markets down. And that's how it works with stocks. A lot of it is driven by psychology and nothing else. All right. Then we have Asia. Like I was saying before, Nikkei is the Japanese stock market index. We have the Shanghai, which is China. This is Hong Kong. This is Korea. I'd have to look up ASX. I don't remember what that one is. Although it might be on the... But what's nice here too is that if you want to read more about this, all the links are right here. Now we can also check out, for example, oil prices. So crude oil is up a little bit. These are the different kinds of oils that are traded in the marketplace. Natural gas is a little bit off. Bonds, these are government bonds, by the way. This is what they're talking about right here. U.S. Treasuries went up a tiny bit. 10-year Treasuries, 0.013% is enough to make the markets nervous. All these other government bonds went up as well in all these foreign countries. This is Germany, Japan, Great Britain. This is France. So, somehow rates are starting to creep up just enough to make people a little bit nervous. And then we have gold and silver. And I was saying before that gold and silver, especially gold, tends to do well when the markets are in turmoil. And because when people are nervous, they buy gold. The logic being that gold always has a value no matter what else happens in the market. So typically gold prices tend to go in the opposite direction of stock prices. Not always, but it happens a lot. Again, because people see it as the asset of last resort. It's the one thing that will never lose its value. And so they'll put their money in gold when they're nervous. Silver, yes, to a certain degree, but it also has a lot of industrial uses. Same thing is true with palladium and platinum, so they aren't quite as volatile as gold. You know, a lot of the demand for silver, for example, comes from industry. So the price of silver is less influenced by market hysteria and a lot more by the actual demand for it. FX, foreign currencies, these are the different currencies For example, this one tells us how much it would take, how many dollars it takes to buy €1, about $1.21 to the euro. Here, this tells me that I would need to pay 105 yen to get a single US dollar. Here, the British pound, by the way, is bouncing back nicely. In the early days of Brexit, it was down as low as the $1.20 range, and now it's coming back up to about $1.40, which is still low by its recent standards, but it's creeping back up again. I guess people are less and less nervous about Brexit than they were, let's say, 5 or 10 years ago. Now over here, it takes now 1.2597 Canadian dollars to buy $1 US dollar. The Canadian dollar bounces around. Sometimes it can go up to $1.50. Sometimes it can go down to about like $1.01. It just has a very volatile history. In fact, let's take a look at it. Let's go back, let's say, 5 years. And I know it's very faint. The color's a little light, but you can see, look at this. It's just all over the place. That's right. So, by the way, when it gets up to these really high levels, that's the time to take a trip to Canada, because your dollars will buy a lot in Canada. Okay, if you've never been there, yes, they will accept US dollars, but it's still a Canadian dollar economy. So when the Canadian dollar gets weaker, it means our dollars are stronger. It means you can get some real bargains when you shop in Canada. Let's look at a longer time frame. This is going back to the 80s, and you can see it goes through these enormous peaks and valleys. And, you know, a lot of times this is driven by oil prices, because Canada does have a lot of oil. But there's other periods where it's almost like here, it was actually worth slightly more than the US dollar for a very short time. And then it just comes right back up again. And before you know it, we're up around $1.40. So there you go. If you want to follow the Canadian dollar, there's your source for you. And now these are futures contracts. These are telling us what investors think will happen tomorrow. This is not going on right now. And so what else? Did we miss something? I think we got them all, but up here is where you have the actual articles. Like if you go to currencies, they've got all the quotes for all these different pairs, but they should also have articles here somewhere. US markets, for example. Let's see what they've got. No, these are just data. But they do have, as you can see on the homepage, a lot of good articles that you can read and keep up with what's going on in the news. Like these are the articles down here. So if you want to read about all of these. So anyway, that's why I mentioned all this, because the video that we're about to look at was made by CNBC. So you know it's going to be good. All right, that was the whole point of this, but I would have wanted to mention this to you sooner or later anyway, because especially if you're studying economics, you really need to pay attention to what's going on in the markets. And even if not, at some point, like I said, in the future, you'll be investing your own money, and the more you understand what's going on in the markets, the better off you'll be. Okay, and I know there's always a few people who are avid followers of the cryptocurrencies. It tends to be all or nothing with people. You know what I mean? Like they either follow it all the time or they don't bother with it at all. That's been my experience. But anyway, so let's get back to this video now. Now I've got to stop the sharing again. So let me pop this into the screen.
At 1-800-CONTACTS, we're here for people like...
And then we'll carry on. Hold on, where are we? I lost it. There we go. All right, there we go. Let's check this out.
Coffee here in London for £3. Those £3 are...
All right, are we done?
Yes.
Good. All right. So they raised a lot of interesting points in this video. They mentioned how the way it's calculated and may be biased against digital types of products or services, things that we start to take for granted now. And keep in mind, the GDP measure itself, as I think one of the other videos mentioned, didn't really get started until the 1930s. During the Depression, it became clear that um, there wasn't a whole lot of information out there about what was going on in the economy. So government statisticians started gathering up all this data and created what we now know as GDP, among other things. And so, I mean, can you imagine not even knowing the size of the economy? How do you make policy that way? It must have been very difficult. So that's when the government really started getting involved with gathering up all these statistics. But there's always going to be flaws with any type of model that you create, especially when originally, when GDP was first dreamed of, most people worked in either farming or manufacturing. And so it really, it may not be keeping up with what's actually going on in the economy to a certain degree. It certainly may be understating the true value of all these wonderful digital services that we now have and take for granted. And economists are constantly working on ways of fixing the problem, but it is a long, slow process. But they're working on it. They're trying to improve it all the time to keep up with what's going on in the with technology and the economy itself. um, and other things too get left out, as I think we've already mentioned. Any type of valuable service, especially where no money changes hands, is not going to get counted because it's impossible to attribute a value to it. In other words, if you go to your neighbor's house and fix his car for free, if you did that in a shop and charged the guy $50, that would go into GDP. But because you did somebody a favor, it's still a valuable service, but there's no way of attributing a value to it, and it doesn't end up in GDP. So there's a lot of issues that we're going to find very difficult to get around. But in general, it's really the best thing that we have for measuring the value of what's being produced. And also it does take, like she said, there's that brief scene about pollution. If businesses pollute the environment while they're producing their products, that doesn't end up in the GDP accounts either. And that's something that has to be addressed, because sometimes, that's going to reduce the value of our output. And of course, finally, I think they mentioned it, that no illegal activities will ever show up in the GDP accounts because nobody wants to report them. It's just that simple. So, in general, GDP has a tendency to understate the true value of what's being produced, but it's understood that that's the case. So the numbers that we do have still do a good job of helping us understand how quickly the economy is growing. Anyway, and they also mentioned the idea of inequality. So we're going to introduce now this concept of per capita GDP. Per capita is Latin, it means per person. And so a lot of economists think that we shouldn't really be focused so much on the total GDP, but GDP per capita, meaning how much is being produced per person, because that would be a much better measure of how much our standards of living are improving, hopefully, over time. All right, so we're going to look at that video now, and then when we're done, we'll get back to the slides and go through in more detail how GDP is actually measured. All right, so let's check this one out. Hold on one second. Let me get that link to you. All right, let's check this out. Okay. Are we done?
Yes.
All right, so you know what? We just barely started this chapter. We may as well go back and review it a little bit. Now that you've seen all these videos, I think you have a much better feel for where this is going. So we're trying to find a way to measure the total value of all the production and income in a country. Now, they did mention in one of the videos, there's different ways of doing this. Expenditures, where we measure how much people are spending on these products, and incomes, where we look at the incomes that are generated by the spending on these same products. It turns out that expenditures is the easiest way to do this. And so we'll be focusing most of our time on that. The others are a little bit messy and they're not nearly as popular for that reason, but they all ultimately end up being equivalent to each other anyway. So GDP means gross domestic product, the value of what we produce during a given year. And as it grows, so does our national standards of living. Our wealth grows, standards of living. And of course, you saw in the last video that, I mean, sure, it makes perfect sense. The wealthier we are, the happier we'll certainly be, but even more important, the longer we'll live and the higher, I guess, the more meaningful our lives will be, whatever you want to say about it. But the key detail is that clearly this is an important area. The more rapidly the economy is growing, the better off we'll be in the long run. Okay, so, and I mentioned before that when you hear this business cycles being mentioned in anything you read on the internet, let's say, they're talking about fluctuations in GDP growth. And we go through typically 4 phases of the cycle, which you can kind of visualize. I think I may have drawn this once before, but if you can imagine that over time, this would be time right here. And this is GDP growth. It doesn't just grow in a straight line. It goes through these cycles, maybe not quite so even like this, but in general, the economy is growing quickly. Well, actually, this is not growth. This is actually just GDP. All right, sorry about that. This is the GDP itself. It's growing. Now, the straight line is what we call a trend line, which represents the average that it grows at. So let's say that on average, GDP grows by 3% per year. That means the slope of this line is 3%. And so there's ups and downs and ups and downs. And in fact, if you want to see what these numbers really look like, we can always visit a very special website. It's called FRED. I don't remember if I showed this to you before or not. It actually stands for Federal Reserve Economic Database. And it has all these different economic series that you might be interested in. So let's just look at the last 5 years, let's say. And yeah, it's kind of a boring graph because they only are reporting this every quarter. Let's see if we can find a more interesting one. Oh, no, how boring. Oh, this is quarterly, that's why. Let me try something else. So let's try this one. Well, all right. See, with such a long time frame, it's hard to see the ups and downs. Yeah, I'm kind of disappointed in these graphs. Oh my God. All right, let me try something else. Yeah, well, these is, you know, these are pictures of what it might. Oh, here we go. I think this is a better one. This is what it really looks like. But if you want to see, like, this graph gives us a better sense of what's actually happening. So, oh God, I lost it. Here it is. Here it is. All right. So you have to imagine that this line is the trend line. That shows you how quickly the economy is growing on average. That's the key word, average. It goes through ups and downs. You've got these periods of enormously rapid growth, which eventually hit a limit, and then the economy starts to slow down. We bottom out here. This is called a trough. And then we started to wake up again. And before you know it, we're zooming along. We hit another peak. And then it starts to slow down again. Now, unlike what this graph is showing you, the distance between the peaks and troughs isn't always the same. It's not quite this predictable. In other words, sometimes the distance between the two, the peaks, let's say, it could be as little as 1 year, and it could be dragged out over several years. So every cycle of every phase of the business cycle doesn't necessarily always last the same length of time. But what's important is that if you notice, this trend line shows that the economy does continue to grow steadily over time. Now, on average, we're hoping for roughly 3% per year growth, which doesn't sound like much, but at that rate, the economy's size roughly doubles every 25 years or so, or about once every generation. The entire economy doubles if we can achieve a 3% growth rate every year. So that's pretty impressive, doubling every 25 years. And even though we may only be growing 3% a year or so, it does pile up. Okay, so that's a lot of growth. And so in the US, that's been pretty much the experience for the last so many years. Of course, you know that we had the Great Depression and things went really badly then. But since then, the economies have been pretty strong, except that there have been periodic recessions along the way. In fact, you know what we could probably find? Maybe I'll do this later on. I'll see if I can find some graphs that include all of our past history. In other words, the Great Depression and some of the other cycles we've had. It turns out that during the 19th century, we also had quite a few downturns. Not as bad as the Great Depression, but there were quite a few of them. And so it's normal for the economy to bounce around like this. Policymakers, as we'll see later on, do their best to minimize this bouncing around, but there's not a whole lot that they can do about it. They can nudge the economy in the right direction. But, you know, with such a big economy, you know, it's hard to control it. And that's just the bottom line. In fact, I was actually at the Federal Reserve Bank of New York one time. It was actually a class trip. And which in the olden days, you could actually arrange to go on a class trip and visit the New York Fed. It's going to probably be a while before they let us come back inside that building again. But what they did tell us was something interesting. They said, you know, the economy is big. And what we're trying to do here at the Fed is steer it in the right direction. And they said, imagine the following situation. You're driving, you're the captain of a super tanker heading down the Mississippi River. And you know that about a mile down the river is a turn. Well, you know what? You have to start turning that super tanker now. You'll actually make that turn because it takes a mile for the ship to make that turn. It's such a slow, big, heavy vehicle that if you don't start turning it a mile ahead of your target, you'll never make the turn. And they said that this is a lot like what happens with monetary policy in the economy, that the Fed is basically looking ahead a couple of years to see what they think is coming before they decide if they should raise or lower interest rates, because it's just like steering a super tanker. They can't be thinking about 2 weeks from now or 2 months. They have to be thinking about 2 years from now. They have to ask themselves, is it time to steer the ship or not? All right, so it's a very complex process. Anyway, we will spend a lot of time talking about the Federal Reserve System in this class, but not just yet. That'll come later, but we definitely will do a lot of that. And so in the meantime, as we've already seen, an expansion simply means that GDP growth is positive. The peak is when we reach the limit of that cycle, then the economy starts to turn down, and suddenly, before you know it, we're in a contraction, which, as they said in one of the videos, we reach a recession when we had 2 consecutive quarters of negative GDP growth. That's what it takes to be called a recession. And then we hit bottom when we reach the trough, and then we start to go back up again. And so that cycle repeats itself over and over and over again. Now, if you want to look at the actual data, you can find it here at the Bureau of Economic Analysis, and let's see what they've got. Now, the only problem with the big website like this is they've got so much information, you may not be able to find what you want. So like here, for example, you can see where growth has been like the last 4 or 5 years. You probably can figure out why this big downward turn is here in the second quarter of 2020. What do you suppose was the driving force behind this downturn? What's still going on to this at this point in time, which is preventing us from meeting in
COVID.
person? That's right. Yes, exactly. But you notice how the economy bounced back pretty quickly in spite of everything, because the economy was really doing fantastic before all this started happening. The economy was absolutely booming before all this crap started happening. And so now we're trying to get back to something resembling normality. But we're lucky in the sense that the economy's downturn didn't last for very long. So anyway, in the future economics classes, we'll be studying this as one of the many crises that have hit the US economy since the colonial days. And that certainly is a very unusual one because it's not caused by any economic variables, but by something completely external to the economy. And they've got all this discussion here about the exact details. Somewhere in this website, though, they'll have a chart with all of this information. We just have to look for it. See, like they have interactive data. Oh, let's see. What can we find here? Let's see. See, there's so much stuff here. This is probably the one we want. Yes, it is, as a matter of fact. So, let me do this. Let me send you this link, because I think this is a very helpful way to understand what we're talking about when you're seeing the actual numbers. All right, let me do that right now. Make a note of this somewhere. Yes, in fact, why don't you click it on right now so we can look at it together and try to get a feel for what's going on with these numbers. Now, 2020, it turns out that it's so time consuming to gather up this data that it takes about 3 months before all the final revisions are made to these numbers and they become official, which means that the fourth quarter that you're seeing here is still not 100% official. The rest of them are, though. And you can see at the top that the economy reached about $21.479 trillion at the end of last year, of which consumer spending was about 14.5 trillion. Okay, so they said in the video that accounts for more than half of the economy. It actually is closer to 2/3. That represents, let me just check this out. That's about 68%. So guess what? We're the ones who mainly drive the business cycle with our spending patterns. All right, so when you and I decide to buy more than usual, the economy can grow more quickly. And when we decide to save our money, the economy might slow down because we're the biggest component of the economy by a long shot. And then we have what's called gross. Oh, by the way, if you notice here, they break it up into goods and services. And among the goods, I think we mentioned this the other day, we have the durable goods, which are the very expensive long-term goods like cars and refrigerators and, all the things you buy that are expensive and are meant to last for a long time. They fall into this category. And then down here, we have the rest, the things you buy on a regular basis, like, for example, clothes and gas and food and that type of thing. And of course, services we all know what a service is. It means that somebody does something valuable for you without providing with a physical good or physical good. Oh, that's okay. So services now, the services are becoming a progressively larger percentage of the total than they were, let's say, even 20 years ago. So the US has been often referred to as gradually shifting to a service economy away from, let's say, manufacturing, which used to be a larger component of the economy. Then down here with gross private domestic investment, as I mentioned in the video, this is exactly what you'd think, except for residential investment. These are new houses. Okay, so when you buy a new house, it's treated not as consumer spending, but as an actual investment. And you can see why, because a house is a hugely expensive thing to buy, but also you may live in it for the rest of your life. So it really could be thought of as an investment rather than a consumer purchase. Now we also have what we call fixed investment, which is broken down into non-residential structures, equipment, intellectual property. This is all business spending. So like if your local Starbucks updates all their the blenders, any type of equipment that is designed to produce consumer goods or services falls into this category. All right, so in other words, we build a new building to house our new division of our company. We buy a bunch of new computers. All this type of stuff goes into this category. And so this is investment spending. And then inventories, when we build new products, but we haven't sold them yet, they go into this category, changing private inventories. The idea here is that if I build cars in December that are not sold until January, I still want to include them in 2020, but I can't put them in one of these other categories because they haven't been sold yet. So instead, the way they work around that is to put it into this category, change in private inventories. So we had a big change here, which means businesses invested, they built a lot more new products that did not get sold by the end of the year. Okay, you can see that number was way, way down in the second quarter when the COVID hit, because businesses were worried about what was going to happen in the future. Okay, and that's not surprising. And it started in the first quarter, actually, minus 52. Look at that, that's huge. But now it's rebounding to a certain degree because businesses are starting to become confident that things are slowly returning to normal. All right, you can see, look at the numbers we used to have down here. They're all positive in fairly large numbers. So this 298, this is a disastrously large downturn. Net exports, we're going to talk about that in fairly great detail. This means that the US buys a lot more foreign products than foreigners buy of our products. Now, these are some big numbers. That's $805 billion for 2020. That's been going on for roughly 30 years. Every year we have more imports than exports, and we end up owing money to foreigners. So you can see what the problem is. We have $2.2 trillion worth of exports, but $3 trillion worth of imports. Okay, so that's where that deficit is coming from. And then they do break these down into goods and services. We usually have a surplus in services. Yeah, you can see that. We exported $678 billion worth of services. We only imported 458.6 worth of services, but where we're getting hit is in the goods themselves, okay? The deficit there alone is almost $1 trillion. And then, of course, this is government spending. And as they mentioned in the videos, this does not include transfer payments. This is just the actual purchases of goods and services broken down into federal, which is itself broken down into national defense, non-defense, and finally state and local. All right, so this in a nutshell. Now, of course, you can further subdivide these categories much more if you want to and look at more details. For example, you can get a list where all the different durable goods are shown, all the non-durable goods. And if you want that kind of detail, they have other charts here somewhere where you can find them. Okay, but for our purposes, this is quite sufficient because we're seeing the big picture, and this is how GDP is measured, at least in the expenditures approach. this is the expenditures approach because what we're seeing here is how much was spent on each of these items, not how much income was generated, how much was being spent. All right, well, it's kind of good to know what these actual numbers look like, I think. And also, I mean, if you need any more information, the Bureau of Economic Analysis has it. It's part of the Department of Commerce, of course. Where else would they put it? That's the Department of Commerce is set up to encourage business. All right, they want to make sure that our markets are as competitive as possible. And so that's why they're there. Now, how do we measure it? Now, formally, we only count final goods and services produced within the borders of the country during a given year. We do not count anything that does not trade in the market, for which no money changes hands. We do not count the so-called intermediate goods. So let's say that, like a good example would be wheat. You and I consume wheat only indirectly when we buy pasta and bread and things like that. We don't go to the store and buy stalks of wheat and bring them home, do we? No, we don't. Can you imagine how chewy it would be? So the value of the wheat that's grown by farmers is not included separately because it's incorporated into the value of the bread and the pasta that we do buy. So we're never going to see intermediate goods counted in the GDP measure because that would double count it. In other words, it would appear that we produce more than we actually have. So a product like wheat, while it has a value, that value is incorporated into the value of the pasta and the bread that we actually buy. So they'll count pasta and bread in these accounts, but not the wheat. All right. It's an important distinction. Yeah, okay. So we've already seen this example. And there's tons of them too, like steel. You don't go to the store and buy slabs of steel, do you? No, but it comes along when you buy a new car, the steel is already part of your car. So the steel isn't getting counted as an intermediate good, but it is getting counted when it adds value to your car. It has to be newly produced. They mentioned in one of the videos that if you buy a used house, a house that's already been out there for a while, it doesn't count because nothing new was produced during that year. It's only newly produced goods and services that we're interested in. Okay, used goods were counted in the years in which they were produced, and that's it. That's what we want. Let's see. Yes, exactly. Same example. Within the borders of the country, they mentioned that too in one of the videos. They're only counting what's being produced in the United States, even if it's being produced by a foreign company. Okay, like I said, a lot of cars are produced within the borders of foreign countries. It's cheaper to ship your cars to the domestic market if it's being built in that country. So the Japanese have factories here where they build Toyotas and Nissans and Hondas and all the rest. We have factories in other countries where they build General Motors cars and Chrysler cars. And it's not that uncommon, but the GDP will count whatever's being built here within the United States. The United States, even if they're Japanese companies doing the building. The logic being that that still generates incomes for Americans, even if it's owned by a Japanese company. All right, in other words, if you go and visit one of the Japanese factories in Tennessee, you'll find that most of those workers are Americans. All right, well, anyway, so GNP, on the other hand, is the one where we only care about the citizens that produce those goods and services. So here's some quick examples. If Ford builds cars in the United Kingdom, the value is included in our GNP because it's an American company, but not our GDP because they're being produced outside of our borders. So, you can see we're going to gain some things and lose some things, and both measures are more or less equally valid, but they're just a different way of looking at what is being produced. But from Japan's perspective, if we have Nissan building cars in the United States, They're going to get counted in our GDP because they're being built on American soil, but not our GNP because it's not an American company. Okay, so you can see we have to get used to the way these two are being measured. And incidentally, right now at this point in time, most economists focus more on GDP rather than GNP. I don't know exactly why, but that's been the trend in the last 20 or 30 years. So then formally, what we can do is, in order to figure out one from the other, we can note that GDP does not include these net factor income receipts because they're not being produced in the United States. These are net factor income receipts basically represent ways in which Americans can earn income in foreign countries. And so because these earnings are happening in foreign countries, they cannot be included in GDP, but they will be included in GNP. All right, so for example, what do you suppose belongs in here? How about if Americans work in foreign countries? How about if Americans buy businesses in foreign countries and earn profits? That type of thing gets counted in GNP, but not GDP. All right, so now let's think about, oh, and by the way, there's other things here too. Interest from capital. If you own a building in France and you're renting it out to a French company, whatever they're paying you is going to count as an income receipt, but from a foreign country. There's land, there's profits from entrepreneurship, owning businesses in foreign countries. All of that counts as income receipts. And we're trying to capture how much income comes into the US from foreign countries versus how much we are paying out to foreigners. The difference is called the net factor receipts or net income receipts. All right, so now what else is different? Yes, and you recognize those as the four basic factors of production that we looked at earlier, and each one has a specific rate of return. Wages earn labor, labor earns wages, capital earns interest, land earns rent, and entrepreneurs earn profits, as we call them. Nobody should be shocked by these, but again, these are very general categories. In practice, it's a lot more complicated than this, but this will do the job for us. All right, so we're going to include wages, this is in the US, that is, earned by Americans working abroad, minus wages earned by foreigners in the United States. It cuts both ways, but it's the difference that we're interested in. Okay, if this number is positive, it means that Americans are earning more wages abroad than foreigners are earning in the United States. What else is in this category? Interest from foreign investments. If Americans own foreign stocks or they keep their money in foreign bank accounts, that goes into this category, but so does the amount earned by foreigners who invest in the United States. Rent earned by property owners. If an American buys a building in France and rents it out, they're going to count that in this category. Or if it's the other way around, what if an American company is doing business in a building owned by Japanese investors? We're paying rent to Japan, basically. So the difference between them is what we mean by net factor payments. All right, and what was the last one? Profits, yes. If you've ever been to foreign countries, you see a lot of American franchises, don't you? Like McDonald's and Burger King and Wendy's and Kentucky Fried Chicken. All of that counts as income to the United States because those are profits earned in foreign countries. But we also have foreign franchises here too. And that money flows back to those foreign countries. All right, now, what is the difference? As I mentioned in the video, expenditures versus incomes. So up to this point, we've been exclusively talking about expenditures. And there is an alternative approach called the incomes approach. But the incomes approach has issues. In theory, they should be equivalent to each other, but in practice, there can be discrepancies. And I think you'll find if you look at both approaches, the expenditures approach is just so nice and straightforward. The incomes approach is actually extremely complicated, which means that we're going to focus on the expenditures approach. But don't worry, we'll get to those details in a bit. And then we're going to look at how GDP is broken up the way we saw in our chart here. God, where was it? In the table, yes, the table. So you notice there's basically 4 categories here, the bold-faced ones: personal consumption expenditures, gross private domestic investment, net exports of goods and services, and finally, government spending. Those are the 4 basic categories into which all components of GDP are assumed to belong to one of these 4 components. So this is how they're abbreviated from now on. Personal consumption expenditures, we'll call that C. C for consumer. Investment, business investment, actually, that's I. G for government expenditures. And then finally, NX for net exports, which means, as you know from the video, exports minus imports. And this is the only component of GDP that can actually be negative. Right? The other is no, you can't spend negative amounts of money or invest negative amounts. So this is the only one that can be negative. Well, let's take a look at these just a little bit more closely. But I think they're pretty self-explanatory, but let's take a quick peek. So as we saw already, consumption expenditure, we typically break it up into goods and services, and those among the goods, we break it up into durable and non-durable goods. So we said before that durable goods are meant to last for a long time, and they're typically very expensive. And even more importantly, they're financed with credit. So if we go back to our table, if we haven't already, let's take a look at the demand for durable goods during the COVID crisis. I'm expecting to see a significant drop, but maybe not. No, it seems to have stayed roughly, although it did jump up. Look, it went from about 1554 down to 1496, down further to 1478, and then all of a sudden, boom, it's back up to 1753. That means that, well, partially I'll tell you why that is, because interest rates were maintained at such low levels. That's an important detail because durable goods are usually financed with credit. So because credit interest rates are so low, that encouraged people to buy more durable goods than they otherwise would have. So that's part of the reason why it didn't really fall off that much. Okay, so anyway, durables, yes, officially 3 or more years is what they mean by durable. And of course, we have the big ticket items that you don't buy very often. Autos, furniture, and appliances are typical examples. But the key that ties them all together is that they are typically financed with credit. All right, let's see, non-durables, the things you buy all the time, so you're not likely to cut back during a recession or other crisis. They're not typically financed with credit either, so interest rates don't really affect their demand very much. Investment spending is, remember, investment spending, except for residential, which is new housing, these are designed to make a profit in the future. So the demand for investment spending will depend very heavily on interest rates, because obviously the lower the rate of interest, the cheaper it will be to invest in your company. But also this is driven by expectations of where the economy is headed in the future. If we see a turn down, the economy slowing down, we'll cut back on this immediately. As we saw in our table, the inventories dropped off quite dramatically, as we saw. because of the COVID crisis. This is not the time to be building new products if you're not sure when or how people will be able to buy them again. So that fell off through the floor. Luckily, it rebounded a little, and now here it's getting back to more normal levels. All right, and then fixed investment dropped from 37 to 34, and it's back up. This is again because of the crisis. So you see, it starts to have a magnifying effect. When one of these components starts to fall, it drags down some of the other ones as well. And then incomes go down, and then we can afford to buy less, and it starts to become a self-fulfilling or sort of like a vicious cycle situation. All right, residential is new housing. Not existing housing, that doesn't count because nothing new has been built during the current year. Whereas number two, this is business only. These are things they bought for the express purpose of making money in the future. This is heavily influenced by interest rates and the state of the economy. So yeah, this one is very, very sensitive to outside factors. Business inventories, again, businesses don't build inventories unless they're confident that they can sell them in the future. And financing, actually both of these, all three of these components are very, very sensitive to interest rates. Low interest rates encourage investment spending. High interest rates discourage it. And again, as we'll see later on in the course, this is why the Fed is so important, because when they lower rates, it can have a major impact on the economy. But when they raise rates, it can really slow things down quite a bit. All right. And confidence too. I mean, obviously confidence is a huge deal. If businesses are worried about the future, just like individuals, they'll cut back on their investment spending. Now, there's like individuals, when do you buy a new house? Not when you're worried about the economy, but when things are going well. You can always stay in your house a little bit longer, or your apartment, if you're worried about the future. Government expenditures, this one is pretty simple. All we really need to know here is that it's broken down into federal, state, and local, and it is not really responsive to changes in variables like interest rates. This is done for political reasons, not so much because, of course, they're not trying to make a profit, so they wouldn't cut back on any of this just because interest rates went up. So this is a separate category. It's sort of, we often end up treating it as a constant when we're analyzing, as opposed to the other factors which are directly influenced by either interest rates or other factors. All right, and then we have net exports, and we are, by the way, and we don't count transfer payments. And then we have net exports, which you already know what that means. And we also know that the US typically has a negative net export, or in other words, a trade deficit. That's just the way it goes. But here, unlike the others, this one is heavily influenced by exchange rates. Okay, now if you've ever traveled, you know that the exchange rate is just the ratio of exchange between one currency and another. And we're going to see that if the dollar gets very strong, that will tend to make our net exports drop. If the dollar is weak, the opposite tends to happen. Also, the net exports tend to improve during a recession because we don't buy so many products from abroad. All right, so sometimes an improvement in the trade balance might not be for very good reasons. In fact, if we look back here again, our net exports, right about here, if you notice, it dropped off to not good numbers during the first 2 quarters of last year during the COVID crisis, but then it went right back up to its more normal levels. Look at that. So anyway, yes, you can see when things are going well or going better, then we're going to have bigger trade deficits because we buy more from abroad and their economies are not really influenced by this. All right. And I mentioned before, this is the only component that can be negative. And I did this. This is a graph of what our trade balances look like for the last 50 years. Well, you get the picture. This black line means even, a balance. And well, you can see we haven't gone above that line very much lately. I mean, really, look at this. And man, look at this right here. We got, well, let's just say the deficits have been very large lately. But here during the housing crisis in the late 2000s, the trade deficit shrunk quite a bit because we couldn't afford to buy as many imports as usual. All right, so this is the one case where the dollar has a huge influence. And so this is a separate category. And now finally, we're going to tie all these together with this amazing little equation, which shows us how GDP is calculated from those 4 components. And so we call this the GDP identity because this accounts for everything. All right. So now we still have a ways to go in this chapter, but we're sadly out of time. Now, what's coming up next is that we're going to briefly, and I mean briefly, introduce the incomes approach, just so you can see what it looks like. And then we're not going to consider it again. Instead, we're going to go back and analyze some other key ideas and do some actual calculations. So there's a lot of fun coming up. So, but for now, I think we'll stop right here. If I find some more cool videos, I'll bring them along. But I think right now, this will do for today. And so I'll see you all on Thursday.
Thank you very much.
Bye.
Professor.
Okay.
Have a
All
great
right,
day.
see you next
Thank you.
time.
Bye,
Thank you.
Professor.
Bye.